Torsten, let's focus on the US side of things and then we can get to a more global dimension. Let's focus on the US with the tariffs in mind. Is it too early, Torsten, to expect those tariffs to show up in the data this morning?
No, it's not. What really is the key issue here is that there is indeed going to be some upside pressure on inflation. And what's most critical about this is that it's all about the behavior among companies. How do they respond to tariffs? Do they pass on 100%? Will they pass on 50%? Or will they pass on nothing? If they pass on nothing, of course, then tariffs have to be absorbed by the E and the PE ratio, namely by earnings. So it becomes very important, the data print today and for the coming months. And we should expect to see some upside pressure on inflation coming from tariffs. But it's also the upside pressure we're watching that's coming from what's going on with the dollar. The dollar is down quite significantly since the beginning of the year. This is also beginning to creep in as a risk to the upside for inflation. And finally, the other thing that's also beginning to become a risk is that the restrictions on immigration. We saw last Friday some upward pressure on wage inflation. This is also something that's an upside risk to inflation over the coming months. So the bottom line to your question, Jonathan, is that we should expect to see from a number of different forces upside pressure on inflation for the next several months, including in the data today.
Will it be sustained beyond the next several months, Torsten, as you alluded to? As you indicated, that is the key question right now, the central question for a lot of people in financial markets. What is on your dashboard that guides that for you?
Well, my dashboard is to type ECFC go on Bloomberg and look at what the consensus is expecting. And that will tell you that CPI is expected to go up from 2.6 to 3.3 by the end of the year. So that's roughly a half a percentage point increase in inflation. And that's the same for core PCE and for headline PCE. So the issue there is that we should expect to see this take quite some time because it all depends on the company's behavior in terms of when do they begin to implement higher prices on the back of inflation going up. And that is something that in the profile of inflation unambiguously pushes us up above 3%. And this is very important because the starting point, if we had started with inflation today at 1.5 and we had 0.5%, then we would get much closer to the Fed's target. But the problem is that the levels we're at, 2.8 of inflation today, is already at a level that is significantly above the Fed's target. So if you add a shock of lifting another 0.5 percentage point to inflation, that really complicates the Fed's job and therefore makes it very difficult for them to cut rates in an environment where there's so much upward pressure on inflation.
So Torsten, in an all other things being equal world, right, when you slap a tariff on, the price of those goods move up. I think that's clear. There are some offsets, though, potentially. I'm interested in your thoughts there. One, right, energy prices have been lower now for a kind of sustained period of time, so there's some disinflationary potential there. Also, the ISM service number last week came in below 50, and so there's some signs of slowing in the service economy. So how do you think about some of those potential offsets, and do you think they're enough to maybe stunt the impact of what you're expecting from a tariff perspective?
No, you're right. From a growth perspective, lower energy prices is certainly helpful. But core PCE and core CPI, of course, excludes food and energy. So from the Fed's perspective, they would likely focus on that there is general upward pressure in the broader measures of inflation, excluding food and energy. And to your services, it's right. NFIB has been showing some upside pressure also on the expectations to inflation. There's also some measures, of course, of inflation expectations, both from the University of Michigan and the Conference Board, that is also telling you that inflation expectations are way too high relative to where the Fed would like them to be. So you're right, there are some nuances in terms of, yes, there are different things going on in some of the, especially survey-based data of what's going on with inflation, especially when it comes to household expectations being very, very high. So combined, I would still come to the conclusion that I worry more about the upside risk. This is also what the Fed has in their own forecast. That's what the consensus is forecasting. That's also what we're forecasting. So for what it's worth, I still think that the overall risks, yes, surveys may show that ISM was a little bit weaker when it came to prices paid, but the bottom line is that the tailwinds coming from tariffs, coming from a lower dollar, coming from restrictions on immigration are just pretty strong. And that's combined with, at the same time, a slowdown in growth, partly because of tariffs, of course, also weighing on sales for companies, but also a slowdown in growth because of the new factor that's emerging, namely consumers are beginning to take a hit now because student loan payments are restarting. And people are beginning to take a hit on their credit scores if they don't pay their student loans. So the New York Fed is estimating that's as much as 6, 7, 8 million households that now are at risk of no longer being able to get credit. So that's a headwind to growth, while we at the same time have some upward push on inflation. So that's stagflation in a nutshell as the baseline scenario that we view as the most likely case at the moment.